In today's rapidly evolving digital landscape, the concept of money is undergoing a significant transformation. We're moving beyond physical cash and even traditional electronic banking into the realm of digital currencies. Bitcoin and other cryptocurrencies are leading the way, offering an entirely new approach to how we store, transfer, and think about value. These digital currencies promise security, transparency, and speed, but they also raise important questions about the future of finance. So what exactly are digital currencies, and how are they changing the financial world as we know it? Let's dive deep into this exciting topic.
Stories about Bitcoin. It is surging and how. Yesterday it hit a new record. One Bitcoin was priced at $69,000. This was an all-time high for Bitcoin.
Ponzi schemes.
The only thing that you have to show is Ponzi schemes. It's all bullshit.
To understand digital currencies, we first need to recognize the major shift they represent. Unlike traditional currencies like the US dollar or the euro, which are issued, regulated, and controlled by governments or central banks, digital currencies operate on decentralized networks. These networks don't rely on a central authority to maintain trust. Instead, they use cutting-edge technology called blockchain to validate and secure transactions. This means faster, more secure transactions that can be carried out across the globe at any time without the need for intermediaries like banks or clearinghouses. At the core of digital currencies lies the concept of a medium of exchange that exists entirely in the digital world. Unlike physical money, you can't hold digital currency in your hand, but its value and utility are just as real. Transactions happen directly between users with no need for middlemen, thanks to cryptography, a technology that secures every transaction. Bitcoin, which first appeared in 2009, is the most famous example of a digital currency, but there are thousands of others, each offering different features and use cases. Now let's take a closer look at blockchain technology, which underpins most digital currencies. Think of blockchain as a massive, transparent ledger or record book. Every transaction that's ever made is written into this ledger and verified by a vast network of computers. These computers work together to ensure that the transaction is valid before it is recorded. Once a transaction is confirmed, it becomes a permanent part of the blockchain and cannot be altered. This decentralized system ensures that no single entity, whether a government or a large corporation, has control over the blockchain. This feature is one of the reasons digital currencies are considered so secure. Blockchain technology offers a level of transparency that is unparalleled in traditional financial systems. Because all transactions are recorded in a public ledger, anyone can verify the authenticity of a transaction. But don't worry, this doesn't mean your personal details are exposed. Blockchain uses advanced cryptography to ensure that while transactions are public, your personal information remains private. Each user on the blockchain is represented by a digital address, which acts like a pseudonym. So while the transaction is visible, your identity remains protected. The history of digital currencies goes back further than most people realize. The concept of electronic money didn't start with Bitcoin in 2009. In fact, the roots of digital currencies can be traced back to the rise of electronic banking in the 1960s. During this period, banks began to adopt computers to keep track of their customers' accounts and conduct transactions electronically. This was a revolutionary shift from the traditional method of recording transactions manually in ledger books. By the 1970s, automated teller machines, ATMs, had become a common feature in banks, further solidifying the role of digital technology in the world of finance. The 1980s and 1990s saw the rapid growth of online banking, allowing people to manage their finances from the comfort of their homes. During this time, a computer scientist named David Chaum introduced the idea of digital cash. His invention, called DigiCash, allowed for secure electronic transactions using cryptography to protect the data. While DigiCash didn't succeed commercially, it was a major milestone in the development of digital currencies and laid the groundwork for the technologies we see today. Then, in 2009, the world changed with the introduction of Bitcoin. This was a major leap forward in the evolution of digital money. Unlike DigiCash and other earlier attempts, Bitcoin was fully decentralized and operated without a central authority. Its groundbreaking blockchain technology solved a key problem in the world of digital currencies, the issue of double spending. Double spending refers to the risk of spending the same digital token more than once, but Bitcoin's blockchain made it impossible without needing a central authority like a bank. So why have digital currencies like Bitcoin, Ethereum, and others gained so much attention in recent years? The benefits they offer are clear. First and foremost, digital currencies enable faster and cheaper transactions. Whether you're sending money to someone in the same city or across the world, digital currencies allow you to bypass traditional financial systems. There's no need for bank approval, and transactions can take place 24/7, even outside of regular banking hours. This is especially valuable for international transfers, which traditionally come with hefty fees and long processing times. Another major advantage is accessibility. In many parts of the world, people don't have easy access to traditional banking services. In developing countries or rural areas, it can be difficult to open a bank account, get a loan, or even make simple payments. Digital currencies solve this problem by allowing anyone with a smartphone and an internet connection to access financial services. This is especially important for the millions of unbanked people around the world who have been left out of the traditional financial system. Security is another key benefit. Blockchain technology makes it incredibly difficult for anyone to tamper with a transaction once it has been recorded. Every transaction is linked to the one before it, creating a chain of data that is secure and nearly impossible to alter. This makes digital currencies far less susceptible to fraud than traditional financial systems. Additionally, the decentralized nature of digital currencies means that there's no single point of failure. If one part of the network goes down, the rest of the system continues to function, ensuring greater reliability. However, digital currencies are not without their challenges. One of the biggest hurdles is volatility. Cryptocurrencies are known for their wild price swings. One day, the price of Bitcoin might skyrocket, and the next day it could drop dramatically. This makes digital currencies risky investments and unreliable as a store of value for everyday transactions. For businesses, this volatility can make it difficult to plan budgets or set consistent pricing. Another challenge is regulatory uncertainty. Governments around the world are still figuring out how to classify and regulate digital currencies. Are they a form of money, a commodity, or something entirely new? The answer varies from country to country, and this regulatory patchwork can create confusion for businesses and investors. Some governments are embracing digital currencies, while others are imposing strict regulations or even outright bans. As the technology continues to evolve, it's clear that more standardized regulations will be necessary for digital currencies to achieve widespread adoption. Security concerns, while much improved thanks to blockchain, still exist. While the blockchain itself is secure, the platforms where people buy, sell, and store their digital currencies, such as exchanges and digital wallets, can be vulnerable to hacks. Several high-profile attacks have resulted in the theft of millions of dollars worth of cryptocurrency, shaking public confidence in the security of these systems. Despite these challenges, the future of digital currencies looks bright. One of the most exciting developments is the exploration of central bank digital currencies, or CBDCs. These are digital currencies issued by central banks and designed to operate alongside traditional forms of money. Countries like China and Sweden are already well into the process of developing their own CBDCs, and others are sure to follow. CBDCs could offer many of the benefits of cryptocurrencies, such as faster transactions and lower costs, while also providing the stability of government backing. As the technology behind digital currencies continues to evolve, we're seeing improvements in areas like scalability and energy efficiency. For example, newer cryptocurrencies are using proof of stake rather than proof of work to validate transactions, significantly reducing the energy consumption required by older systems like Bitcoin. These advancements will help digital currencies become more environmentally sustainable and able to handle larger volumes of transactions. Conclusion. So, whether you're an investor, a tech enthusiast, or someone simply curious about the future future of money, digital currencies are something you can't ignore. They have already sparked discussions about what money is, how value is transferred, and what role governments and banks should play in our financial systems. While the road ahead is full of challenges, it's also full of exciting possibilities. As digital currencies continue to grow and evolve, they could reshape not just banking, but entire sectors of the global economy. Thanks for joining me on this journey into digital currencies. Stay tuned for the next chapter, where we'll dive into Bitcoin. Feel free to share your thoughts and spread the word as we continue exploring the future of money and technology.